Thank you so much, Sarita ji, for that long introduction. But uh, thank you. And thanks to once again Sharma sir. Thanks to Divyajyoti Foundation for providing me this opportunity. And thanks to all the participants for joining in. So as Sarita ji has actually already helped me to cover 2 slides, what I wanted to cover. So that's good. I'll focus a little more on the content in terms of the valuation part and what are the intricacies in terms of valuing the intangible asset. So it is honestly a little complicated topic, but I'll try my best to give justice to this topic, and we can start. So I'm sharing my screen with all of you. Let me know once it is visible. If it is not, do let me know.
It's visible.
Okay, great. So uh, in case if anybody has any clarification, you can always unmute. Though I have kept a Q&A session towards the end also, but feel free to stop me if there is something relevant to the slide which we are discussing or any of the topic. And also, in case if there are any questions which I'm not able to answer, so maybe I'll take a note of it. And then with help of Divyajyoti, I definitely come back to you with the answers on that, just in case. So before we get into or dive into the topic, I just want to share a very interesting experience when I got an assignment to value an intangible asset. So it might sound like a story, but it is just very interesting. And this will cover some of the very important aspects which I'm going to discuss during the session also. So through one of my colleagues and friends, I got a call from someone from North India saying that they want to do a valuation for an intangible asset. So I was very glad to know that the person talking to me understands what is exactly an intangible asset. So when I dwelled further into it, I understood that the person is from an economics background, so he understands. So then we got into a call along with my colleague, and it was a Zoom call. So I asked him what exactly is the intangible asset we're talking about. So he said it's a video portal. So I said video portal, and so I said I think it is something like a YouTube. Yes, he said it's something like YouTube, but not exactly YouTube. So I was very happy as a registered valuer because whenever we look at any product or if we have to value anything, we always look at these market comparables because always back of the mind you have these approaches going on: market approach, income approach, and cost approach. So I was glad to know that okay, I can use a market approach over here if it is similar to the YouTube channel. And we started further discussing in terms of, so he took me through the portal. It was very similar to YouTube. Then he showed me some of the videos which were uploaded, and I could see the chief minister of the state in the videos. I could see some of the very renowned state banks in the portal, and I could see the name of this company also, which has uploaded these videos. And the name of the company was ABC Limited. So I'm going to keep everything discreet for now. Uh, and then I said, okay, this is the asset which we need to value. So it is basically a portal. And what else is there in the balance sheet? Or can I see some kind of documents, financial statements? He says, sir, we don't have any financial statements. I said, okay. How can I prove that this portal belongs to you? So he said, sir, this portal belongs to us. You can check the portal details. I said, I want a document. Like today, if I go to YouTube, I create a channel by name the Prakash Kukreja, and I upload 5-6 videos. I will not say that the YouTube is my channel or my portal. So I need to see some documentation proof also. And then comes the interesting part. So he says that, sir, this portal was built in United States of America through gig economy, through freelancers. I said, okay. And I'm sure if they had built the portal is sitting in India right now. Of course, it's a web world. So there has to be some documentation, some transaction that you have bought this portal from the person sitting in US. He said, no, they all were paid in Bitcoins, and Bitcoins has no transaction. So right now this portal belongs to us. I said, I don't understand how do I define the ownership. So that discussion continued. I said, okay, let's come to the point that what is the purpose of this valuation? He said, we want to show this portal in the balance sheet. I said, valuation report is not to reflect the value of an asset in the balance sheet. There has to be a transaction. So you have to first show a transaction that you bought this portal, and then maybe if there is some other purpose you have, then we can look at the valuation. He said no. And then eventually, while discussing, it came out that they are looking for financing the this thing, the portal, using the portal to do some funding for the startup. So it was a startup. I said, then okay, if this is a startup and you want to fund it, he said we don't want to fund it now, but first you want to show in the balance sheet. And then I said, okay, if you want to show in the balance sheet, who are your customers? Uh, so he said, sir, we want a value of 25 crores. I, I said, we don't do any mandate valuation. You can't tell me that I have to value it at 25 crores. It depends on the process, the approach, the method I use, and then I'll arrive at a value. You can't tell me you want a value of 25 crores. And then, so eventually, then this person says that, okay, sir, so maybe you only can prepare the balance sheet and you can do the asset valuation. Then we will show this asset in the balance sheet. And then maybe 6 months, 1 year down the line, we look at the ECB, external commercial borrowing. Basically, they wanted to fund it. So, trust me, friends, it was such an interesting discussion for almost a couple of weeks. I just covered it everything in a very short way. So every time discussion came up with something new, and I realized that this person basically wanted to fund their startup based on a valuation report prepared by me, and this intangible asset was actually not their asset. So eventually, I realized that it was all fake. So in fact, I had already given my engagement letter and all that, withdrew everything, and then I did not take up the assignment. So with this story, what I'm trying to say is that please be very, very conscious and ensure that you have these basics in place, because intangible asset is such a critical asset, and I'll cover in some of the slides also. In fact, when I was going to value the intangible asset, I very openly charged a very high fee also, and this person accepted. So the point what I'm trying to do is that be very, very careful, because we as registered valuers carry a lot of responsibility on our shoulders. And if basis our report, the asset is being reflected in the balance sheet and there is the funding happening, so it would eventually be coming back to us also, in case if there is any kind of inquiry. So with that, I'll quickly move to the presentation. So first, let's look at the current perspective, and this will very much cover what Sarita ji just mentioned during initiation of the call. That right now, if you see the way the entire basically because of the technology, the way the technology has grown, so the way this specific class of asset has actually grown is really very interesting. So this is a chart, and this has been sourced from a website called Visual Capitalist. This basically gives a timeline perspective from 1975 to 2020 for all the companies which are part of this S&P 500 index. And each bar represents the total asset size. And the bar is divided into two parts. One is the green part, and second is the silver part. So green one is an intangible asset, and the silver part is the tangible assets. Obviously, we all know what exactly is tangible, intangible. So just for the benefit of all, tangible will be all your plant, property, equipment, something which you can touch and feel. Intangible will be your patents, brand, trademark, your software. So these will be intangible. So if you can see how from 1975, from 17% as an intangible asset, now it is 90%. And especially after 1985, that is why I put the star mark also, because that is where the tech era started. Eventually, the technology boom, we started looking at these personal computers and softwares and so on. And that is where you would see the 32% in 1985 became double almost, which is 68% in 1995, in fact, more than double. So this is how it has grown. And eventually, once we have this 5G, we would have these NFTs, non-fungible tokens, the way the cryptocurrency is evolving, the way the technology is evolving. So the intangible assets definitely is going to grow further and further. And especially companies like Twitter, Google, Apple. So I think they have a large portion on their balance sheet. I would not say 90% here. It depends. It varies from company to company, but a large portion would be actually your intangible asset. So eventually, this gives an idea about how significant this intangible asset is. Now, this is another a little older this thing chart, and this is being prepared by McKinsey and Company. So as of 2019, sorry, the visibility is slightly poor, but I'll read it out for you. So the bars over there are basically comparison between the black bar says that before investing, what is the return before investing into an intangible asset? And the blue bar shows that increase of the revenue of the company after investing in the intangible assets. And the first graph is related to total median for all the industries. And the other 5 are different industries like financial services, telecommunication, manufacturing, retail, and energy. So you would see that the more the investment in intangible assets has gone, the company's revenue has started increasing. So this is how the growth factor is getting covered basis this graph. So again, this shows that how significant the intangible assets are right now. So now you would see a lot of patents, trademark, brand, take any industry for that matter. So every industry would have some or the other intangible asset. Now, so the idea about this presentation is more from a RV perspective, how you can actually look at the valuation. But I'm trying to cover some of the very basics also, because honestly, with my personal experience, limited personal experience, I have seen that mainly the basics don't get covered. So my intention is first we should understand the basics, and then I am covering a case study. In the case study, we'll be looking at different aspects. How do we value the intangible assets? So what exactly is an intangible asset? And here I would request everybody's participation. So these are 5 different scenarios I've highlighted. And what I would request is that maybe any of you can, if you can just unmute yourself and tell me, we can look at the first question first, for that an intangible asset held to be sold in an ordinary course of business, is it an intangible asset?
No, sir.
Okay. So first answer is no. Anybody with a different answer, or if you would like to explain why no?
Sir, then it will be stock in trade.
Absolutely right. Absolutely right. So very
But
simple.
still, sorry,
Yes.
but still it can be an intangible, right?
You will not be valuing this as an intangible. You will be valuing this as a stock, right?
No. How would you value in the underlying principles of valuing intangible should be the same. How you account is should not matter.
No, but ultimately, if suppose you're going to sell this asset, this is a stock, right? So if you are dealing in this kind of a asset, which is intangible nature, so would you be showing this in your balance sheet as an intangible asset or a stock?
No. So okay. So accounting is a different thing.
Correct. I
How
agree.
you do it. But from a valuation standpoint, it has to be the logic
Correct.
principles, methods have to be that of an intangible.
Correct. That is correct. That is correct. But in terms of when you look at reflecting in the balance sheet, that balance sheet will be looking at more of a stock rather than the
Rather we call it as asset held for sale, not inventory held for
yes, that's
sale. So
correct.
it's asset held for sale.
Absolutely. It is asset.
Not inventory.
Correct. You can say that. Yes.
Sorry, why would you call it asset held for sale? Because it says an asset had to be sold in the ordinary course of business. So am I assuming that it's going to be like, if it's inventory, then it's basically, we are saying that this is the business of the company, right? That this is engaged in selling intangible assets. If it is a one-off case, then yes, I would agree that it's going to be an asset held for sale.
So maybe I can just take a very simple example here. Microsoft as a company, that company sells softwares. So it will sell you Windows, it will sell you Microsoft Office. Now, first question is that an intangible asset? It is, right?
It is. I think.
Yeah.
Okay. And now if they have to sell this asset, now this is like an inventory for them, or it is an intangible asset which is generating a revenue. Like, let's say, let me compare this with the Microsoft logo, right? Or the patents what they have. So now these patents, they don't sell it, right? The logo, they will not sell it, but these are intangible asset. So the difference is that the Windows, being an intangible asset, is actually held as an inventory. So they will sell the licenses for that asset, which they will renew, or maybe there will be a one-time charge and there will be a renewal on every yearly basis depending on the product. But as far as the logo is concerned, that logo definitely will generate some kind of revenue because that is the equity which they have built. Correct? So does this example answers the difference?
Yeah. So it all depends on how you're using the asset or what exactly is your business, right?
Exactly.
Yeah.
Exactly.
So,
Absolutely.
so in this example of Microsoft, these are licenses which they give.
Correct.
It's a lease of license. It is not a
Exactly.
sell.
Correct.
That is one. And as far as they don't sell the IP, the IP is the intangible, which in case as a one-off case, if they sell, then it's an asset held for sale separately, nothing to do with inventory.
But sir, over here, don't you think they have, when they are selling the licenses, right? So it is an intangible asset, like a stock, which they are actually selling to generate revenue.
But they don't show it as a stock because it's a license.
Correct.
They license it. There is no inventory about it. It's a license for Windows 9, Windows 10, or whatever.
Correct. Correct. Correct.
Okay, maybe another example would be something like the companies which sell IPs, like the websites. I mean,
Like a
maybe that could be one example.
Like a
instead of
domain name.
Microsoft.
Yeah.
Yeah, domain name, exactly.
Exactly. Correct. So another question here, if there is a software which is, can I request if somebody is not talking themselves on mute, please? Can I request if you're not talking, you put on. Okay.
I'm checking, sir.
Okay. Thank you. So another example, which I would like everybody to help me answer this, if there is a software which is dedicated for a computer controlled machine, which means machine cannot be operated without this software. So is this software individually an intangible asset?
No, sir.
Okay. Anybody with a different answer? The answer is correct. So this basically will not be treated as intangible asset because you cannot separate the machine and the software. It is a dedicated one. Now, another one, is intangible asset a monetary asset or a non-monetary asset? I'm sure everybody knows the difference between monetary and non-monetary. So is intangible asset a monetary or non-monetary?
A non-monetary asset.
Correct. Because monetary assets like receivables or creditors, you have a specific value attached to it. So intangible asset will always be a non-monetary asset. Now, what is the importance of the ownership of an intangible asset? Is it important that you should be an owner of the asset if you want to value intangible? Or maybe if I can just rent an intangible asset, I'm just hypothetically creating an example, and then I can.
I think we can take a cue from your first example in the introduction.
Correct.
While you can value it, even if you own it and I want to purchase, I can try to value it, but it doesn't mean important is the ownership.
It's absolutely right, sir. So ownership is very important because if, for example, if I'm giving you the license to use the intangible asset, you are going to use it, but you're not the owner of the intangible asset. Ultimately, I would be the owner because I'm generating a revenue using that intangible asset. So ownership is a very, very important part over here. And the last one is that what if an intangible asset has no future economic benefits?
Then we will write it off.
It's still an intangible, but no value, future value.
Correct. So it would be an intangible, but eventually it will not have any future economic benefit because it is not a revenue generating intangible asset. Now let's look at some of the very basic definitions before we dive deeper into it. So as per the international valuation standards, right, intangible asset should be a non-monetary asset which manifests itself by its economic properties, very, very important. No physical substance, obviously, because it is an intangible, and it grants legal rights and or economic benefits to the owner. So if all these conditions are satisfied, that eventually would be an intangible asset. And if you have to recognize that in the book, so first the condition has to satisfy, and obviously the economic benefits there has to be, you should be able to measure those benefits or the cost of the asset. Then you can recognize that asset in the books. Categories of intangible assets. So very broadly, in fact, there is one more slide which I'm covering by functions. So goodwill, research and development, customers list, could be customer contracts, intellectual property. You have your patents and any kind of artistic material. Then you have your license, rights, copyrights, trademarks, brand equity. This is not an exhaustive list, but broadly, these are the high-level categories where you can classify these intangible assets. And if you have to look at in a functional-based approach, so functional-based approach would be broadly dividing this by 5 functions. One is the customer-based, marketing, contract, technology, and artistic. So there would be some overlap also in some cases, but that depends on case-to-case basis and would be more exactly like how you are using that intangible asset to classify that. So customer base broadly will talk about your non-contractual customer relationships, right? Or maybe your customer list which you have. So for example, Amazon. So they would have millions of customers. If somebody takes over Amazon, eventually the customers will follow, right? So that customer list, there is no contract between Amazon and the customers, but that list becomes a kind of intangible because Amazon over the years has built that reputation and the brand value where they have these customers which are always hooked to Amazon. Marketing based will be all which you use for promotion, brand, logo, and so on. Contract based will be your contractual, like you have, there's a specific contract with the customer which is going to generate revenue. So that would be your contract based intangible assets. Technology would be, simple example would be your application softwares, which are eventually held electronically. And artistic would be broadly your pictures, photographs, music, motion pictures, or any kind of newspapers, magazine, which is more into creative and artistic. So broadly, these are broad categories 5 where these intangible assets are classified. And goodwill is another intangible asset, which is, I'm sure everybody, I think everybody is a qualified CA, CS, ICAA. So I'm sure everybody knows that goodwill as such, we don't recognize as an asset unless if there is a business combination situation, right? Unless if there is any kind of a merger, takeover, amalgamation, and wherever we see there's a difference between the fair value of the identifiable assets and liabilities compared to what the acquirer has paid. So acquiree has paid. So that difference will actually be goodwill. In many cases, you would see there will be certain intangible assets. For example, your assembled workforce, some of your future technology, or any kind of which asset which you cannot value, that will be automatically subsumed within goodwill, and that will get valued or maybe automatically highlighted only during a business combination transaction. But otherwise, as such, goodwill as an asset, we don't value it. So before that, any questions, any clarifications before we look into how do we identify an intangible asset? Okay. Now this is very important, and this is where initially when I shared experience with you when I was looking at an intangible asset valuation. So this eventually helped me a lot to understand whether if I have to identify it as a valuer, I should know that if there is a contract in place or if I can separately look at that asset. So if you have to identify the intangible asset, there are broadly 2 ways. One would be contractual, right? Whether there are any kind of a legal rights, right? So transferability or separability not relevant to establish if an contractual assets is an intangible asset. So if I already have a contract with a customer that for next 1 year or 3 years, I would be eventually supplying all the goods and customer would be paying me for that. So that is a fixed contract. That contract eventually becomes an intangible asset for me. So there is a contractual in place. Now, if that is not the case, can I separate the intangible asset? Can I look at it separately? Because as I said, sometimes goodwill subsumes other intangible assets. Or we took an example in the earlier slides that if a software is attached to a machine, right, it is not separable. So this separability is a very important quality if you have to identify an intangible asset. So it should be separated. It should be able to be transferred. It should be able to be licensed, rented, exchanged. Intention would not matter, but definitely the separability aspect is very, very important. So intangible assets that do not qualify for the separability criterion or the contractual are subsumed into goodwill. We covered that. And some intangible assets merged with goodwill here would be assembled workforce, buyer-specific synergies. Obviously, if there is a business combination, like a takeover, merger, amalgamation, so there would be definitely some synergies. And this is where the goodwill as an intangible asset will take care of that specific synergy. Distribution channels, technical knowledge, training or recruitment programs, customer service capability. So these all would be part of the goodwill because they are not separable. Now, based on the functions which we discussed, the 5 functions, these are some of the very specific intangible assets. And in terms of identification, either they will be part of the contractual or the separability. So I'll very quickly cover some of them. Marketing, as we saw, as we know that trademark, trade names, you have your newspaper mastheads, the title like Times of India, Economic Times, or maybe domain names, something which you use for your marketing purpose. So there is always a contract in place. So these all will be your contractual based intangible assets. Customer related. So customer list and non-contractual customer relationship will always be your customer related. But if there is a contract, it will be part of your contractual based intangible assets. Then you have your artistic related, obviously the plays, books, videos, pictures, photographs. Then contract based would be your licensing, royalty, advertising, your lease agreements, all intangible assets which eventually are helping you to generate revenue, and there is a contract in place. And technology would be your R&D, computer software, unpatented technology, databases, and so on. So this is a very important aspect when you look at these intangible assets, whether you are able to identify it either based on contract or based on separability. Now, a very important question, why should we value intangible assets? So the story which or let's say the experience which I shared in the beginning, the client wanted to actually show the intangible asset in the balance sheet. But that obviously is not the right situation. But there are a lot of other situations where we need to value the intangible asset. So some of the key ones are like business combinations, right? Which we also discussed in the previous impairment of assets. Then if there is any transfer pricing which is happening about an intangible asset between two companies, between two geographies where they are going to transfer the license or maybe provide the authority to use the license. So these would be the areas where we would be requiring to do the valuation. Or if there's a slump sale, so purchase price allocation, taxation, that is where you would need to value the intangible assets. Merger acquisition, we discussed. Financing, this is a very important one. And this is where I think in my experience, I saw that the client actually wanted to use the valuation for. I think one of the famous cases, Vijay Mallya, Mr. Vijay Mallya's case for Kingfisher. If I'm not wrong, I think some of the major amount of loans which they funded through SBI, they were based on the brand value of Kingfisher Airlines. So again, that intangible asset was used for financing over there. Litigation, of course, bankruptcy, restructuring. Then you have insurance, especially for celebrities or any kind of football franchise, cricket franchise. This is where they actually look at the insurance, and before insurance, they will look at the intangible asset valuation. Then sweat equity shares, if there is any kind of a technical know-how and they want to issue sweat equity shares to their employees. So again, that particular asset which has been created or of intellectual property, so that also needs to be valued. Okay. Now, as far as R&D expenses is concerned, I think this is specifically in light of this COVID situation which we had. So I'm just taking COVID as an example over here. because during the COVID period, as much as I could read, I understand that there were many pharmaceutical companies which were actually into coming up with the idea of building a vaccine against COVID, right? But not everybody succeeded. So there was a lot of R&D which was happening. Now, eventually, this R&D would lead to a specific formula of a drug, and which again leads to a patent and eventually an intangible asset. So very important that R&D expenses cannot simply just be treated as an intangible asset, but there are certain conditions, there are certain things which has to be demonstrated. And that is why I've dedicated one slide over here, that if there is a technical feasibility of completing the intangible asset so that it will be available for use or sale. So this available for use or sale is very important. It should not be that it is only going to just more of an experiment that you cannot say it's an intangible asset. It should be either used, either it should be sold. Intention to complete, because R&D, of course, this process goes into number of years. So there has to be an intention to complete and eventually use or sell. There should be an ability to use or sell, and it will generate probable future economic benefits. Eventually, if you're going to sell it or you're going to use it, there should be some economic benefits attached to this R&D, and there should be availability of adequate technical, financial, other resources, right? And eventually, again, use or sell of this intangible asset. And there should be ability to measure the expenditure attributable to this intangible asset. So if these conditions are satisfied, then we can consider if that R&D expenses eventually is going to be considered as an intangible asset. Now let's look at the valuation process. So before I proceed, any questions or any clarification, or anybody wants to share anything in case if they have any practical experience of valuing an intangible asset? Okay. So broadly, I think the valuation process is relatively standard, but in case of intangible asset, I think what I would like to highlight over here is the ownership part, right? Identification part. That is very, very important. So before you actually start the valuation, it's very important to understand in some cases, the intangible assets are clubbed together. For example, if a pharmaceutical company is actually giving a license to a drug manufacturer, right? If there is a principal and there is a manufacturer. So if the license is being given, license could come along with the formula of the drug also, right? So that it's very much possible that there are two different intangible assets attached to it. So we should be very, very clear that what exactly are we valuing? We are looking at a combination, or we are looking at separate intangible assets. What is the purpose of it? Because that will eventually define the premise also of the intangible asset. And then the standard approach follows, where you will look at the financials, historical, and then the outlook. What are the external economic factors? And the very important part would be evaluation approach, because in many cases you might see that there is some kind of a dilemma over here, and that will be based on your judgment whether this intangible asset will be based on market approach, cost approach, or a income approach. So but as a practice, it is always better that you look at all the three approaches. And if you look at one approach, then if there are different methods, you consider all the different methods depending on the data availability. Like for example, in case of income approach, there are 4 different methods, but it depends what kind of intangible asset it is. And then you can take a call. But it's very important that you assess this aspect very clearly, and it should also get reflected in your report so that it is well justified and understood by the reader of the report that why the specific approach or the method was selected. So now in case of approaches, the idea what I'll do is there are broadly 3 approaches. So I'll dwell each one of them and with specific on the methods. And there is a case study which I've added over here. So we will look at the different aspects of the case study, and then each approach or the method, how we can apply using the case study. So important prerequisites before looking at the evaluation. Of course, we all know, very important to know the purpose and the objective or overall valuation assignment. As I mentioned that in my experience, though the client was saying they want to show it in the balance sheet, but eventually the core purpose was they wanted to do the funding using the valuation. So it's very important because that will also derive the kind of approach or it will have that subjectivity element over here when you know the purpose of the valuation. Also consider the legal rights of the intangible assets to be valued, right? So for example, if a registered trademark may have a higher value compared to unregistered trademark, that is very obvious. So in my experience also, when I was talking about valuing that specific portal, I could see that the ownership aspect or the legal rights, if I have to value that asset, I couldn't see any specific document around that. So this is one of the very important hindrance I had, and I had to give up the assignment. So it's very important to understand the legal rights of the intangible assets. Evaluate the highest and best use. Obviously, this is the premise of the valuation. So depends, again, it is related to the purpose. So depending on what is the purpose, like we know premise would be either liquidation, fair value, going concern. So basis that you have to judge the premise of the valuation also. History and development, how exactly, if there was any kind of R&D, how it was developed. So same example, which I discussed in the beginning, when I asked them that, how did you build the portal? So this portal was built in US, and it was built in US by some ex-employees of Google, Apple, and so on. And there was no documentation, there was no trail to show that they had built it, how much they were paid, because everything was paid in Bitcoins, right? So it was very important to understand that overall history and development of the asset, because honestly speaking, if I have to build a website or a portal, max to max, let's say if it is a very high end, you will not spend more than 1 to 2, max to max 5 lakhs, right? Again, depends on a lot of factors, but still that is on the higher side. But if you're expecting a valuation of 25 crores on a portal, that is too much. Whereas your development, so of course there are different aspects. If it is a using an income approach, what is the potential? But again, you can see how the clients come with that perspective in mind, that they want a specific valuation despite the spend which they would have done. And it is very easy to say that we do not have the details about how much we have spent on that. But as a valuer, we should always look at it. Now, specific laws, because specifically royalty as an example, you know that there are a lot of regulations around royalty. I remember recently government also looked at some of the capping the percentage when a company has to pay a foreign company any royalty for using their trademark and patent. Especially, I think when this Vivo, Oppo, all these Chinese companies started coming to India, and they started selling these low-end, cheaper phones. So this was one of the very important segment where all these Indian-based subsidiaries they were paying a huge amount as a royalty to them. So there are specific regulations around these. So if you're doing a valuation, it's very important that you look at if there is any law or regulation which is attached to the specific asset. In terms of approaches, broadly 3 approaches. I think that is standard, market, income, and cost. And within each approach, there are different methods. So market would be based on your valuation multiples. For example, EBITDA to revenue, EBITDA to or maybe employee, or depending on what kind of asset it is. If it's like a application like a WhatsApp, you might have an EBITDA per user, right? And if you have application like, for example, Swiggy, it might be EBITDA per customer, and so on. Then there is a guideline pricing method, which is again comparing related transactions or related company, where you can use that as a guideline. Income approach, 4 different methods. So there would be some other overlap between these 4 methods, but all these are part of the income approach, because this is where we say that the intangible asset has a income generating capability. Obviously, that is where you will look at the income approach. You can use the market approach also, but eventually, if you are able to measure the income and you have the information available, in case of market approach, it is always challenging to get the exact comparable similar company or an asset to actually do the valuation. Plus, a lot of subjectivity is involved. So I have seen that income approach is one of the most preferred approach when we look at valuation. In fact, most of the valuations are based on income approach. Of course, depends on what is the premise, what is the purpose, it could change. But income approach is one of the most preferred one, and that applies to the intangible assets also. Cost approach, again, the same standard. If you want to reproduce or replace the asset, you can use the cost approach. A very simple example, if you have an inbuilt software which is not revenue generating, and if the company is being taken over, so that software which is being used internally, that will be valued based on the cost approach. So before we move ahead, any questions? Okay, so now what we will do is we'll look at a case study, and basis this case study, I will be sharing more insights into these different methods by different approaches. So let me first read out a case study, and whenever you see a slide with more of a blue color, that would be relevant to reference to the case study. Other than the blue color, you would see that it is more about the conceptual clarity of that particular uh, topic with or the method or the approach. And I've also highlighted on the top. So this is ABC Corporation. It is the largest satellite radio provider. Now, satellite radio as of today is not very prevalent, but I'm sure many of you would know that somewhere in 2005, 2008, there was a new company which came as called World Space. And if you recollect the movie by Mr. Rajkumar Hirani, Lage Raho Munna Bhai, in that movie, when Sanjay Dutt Munna Bhai was actually doing this as a radio jockey, so you would see World Space as a radio. So it's a satellite radio. So satellite radio is basically a technology which works on a satellite, and it has all international channels specific programs also. So ABC is a satellite radio provider, right? And they have been in the operations for 5 years, and government had granted satellite spectrum licenses to 4 startups. So from one of them is ABC, to cultivate and then burgeoning industry. Again, it was a new thing at that point of time. Since the time precipitated by the accelerating wireless data needs, like now the technology has evolved, so you can actually listen to radio online as well using an app. So then the telecommunication industry and the government has stated that it will not be licensing any new spectrum for satellite radio, but may approve the sale or transfer of the existing spectrum. So basically they can sell or transfer the spectrum, but there will not be any new licenses being given, or the spectrum which will be given to the new companies. And so ABC generates its revenue from monthly subscription to customers sourced via a direct retail sales channel, which is direct email, print, television, advertisement. So very simple, like if they had to sell this satellite radio concept, so obviously they will do this marketing, and the customer has to get the subscription. It could be a monthly, quarterly, half yearly, annual subscription, and they can become the customer. So it becomes a contract between the customer and the ABC company. And ABC does not manufacture the radio, so that is the hardware device. They do not manufacture, but basically what they do is they have these satellite radio signal receivers that is being sourced by somebody else, but the signals which are get transmitted, they have the authority to give those transmission, right? And these can be received by unit once it is registered, activated by as an ABC unit. So you can buy it separately, register with ABC, and get into a contract with ABC. You will be able to use the services of the radio, and there will be different channels, like there will be Hindi songs, English songs, and so on. Then after 5 years in the operation, there's a lot of research and development which ABC did, and they built a proprietary software technology. So this is a new thing which they have come up with. This is the R&D for transmission of on-demand radio content. So this is a technology which they built, right? This is their R&D, and this is a on-demand. So if somebody asks for it, for example, I'm sure many of you people using Tata Sky, you would see that there is an on-demand channel. If you want to see a specific movie, you have to demand for that movie, you have to pay, and then you can use it. So this is like a on-demand content, a radio content. So as a result, what happened is this was very much I think it was in good demand, distribution stations. So radio has these stations, so they created these stations, and they were more into these educational programs for parenting. Then there was a channel on finance, history, motivation, biography, and cooking. So they created these different channels. They created content for these channels. And this premium service is only offered to customers that are regular subscription. So if you are a subscriber, then only you can use this. And of course, you have to pay for it, but it's a separate one. But only if you're a subscriber. So somebody can just come and say that, okay, I want only the on-demand content. No, you have to first become the subscriber. So that is an underlying condition. The success of this novel business was immediate and generating incremental revenues of approximately 45 million last year. Most of the ABC's regular music and talk radio content is acquired from third-party sources based on normal recording industry. So this is a royalty-based pay scales. So they acquire from the third party and then they broadcast on their radio channels. And again, it's a royalty base. So somebody creates it, then they would pay the royalty. However, the exclusive broadcast on its premium on-demand channels, ABC produced an archive of 1020 to 60 to minute. There is a 20 to 60-minute proprietary programs they created, and these were they built these. So the content was built by them, and they were protected by copyright created via internal publishers like third-party consultants, doctors, professors, depending on the content. Two of the ABC's competitors operate in B2B space. Now, see, this is a difference. There are 4 startups. ABC is into retail, but the other two, we don't know about the fourth one, but the other two are into B2B space. So they're not into retail. So this brings a difference upon that ABC is B2C, whereas the other two are B2B. So there is no comparable information which is available right now for them. These two competitors, they provide satellite radio content to the airline, commercial real estate industries respectively, and they are unbranded product offerings. So this is about the company. This is a forecast for 5 years. Of course, we will dwell more into it when we look at specific example, but this will give you in perspective. It's like a P&L statement. And you would see that they have done a valuation based on 5-year forecast, revenue, regular on demand. Then you have your cost of sales, gross profit, operating cost, R&D expenses, selling and marketing, general and administration, and then the EBITDA, depreciation, EBIT, taxes, depreciation, capex also, working capital, and then they have arrived at what is the residual value. So they have used the income approach over here and calculated the terminal value, which is your residual value. And you would see that the present value of total is around 1.2 billion, which is 1199, right? And the debt which they have is 400. So the fair value of the shares is 800 million, which is 0.8 billion. So this is how the valuation is done for ABC. Now, after this valuation, what happens is shares of ABC were acquired for 0.8 billion basis this valuation. You would see this 0.8 billion as a fair value, right? 0.8 billion. And then the net debt, which we saw in the previous slide, which was around 0.4 billion, and the tangible assets acquired were around 0.5 billion. So if you see here, the purchaser of the ABC, it would like to also look at what are the different intangible assets, material intangible assets, and how we can value them. So the person has approached you for financial reporting and tax needs. And then if you see on the left-hand side, equity price, which was 0.8 billion, the net debt is 0.4. So obviously the enterprise value would be 1.2, which we saw in the previous slide. Now the tangible assets is 0.5. So obviously the balance becomes net in the balance intangible assets, which is 0.7 billion. Now, if you go back to the slides where we looked at the overall business overview, here there are different intangible assets which this ABC company has. They have a trade name, let's say ABC. They have on-demand technology. So this is a technology which they build basis the R&D for 5 years. They have customer relationships, right? They have been in the business for 5 years. So they have contracts with their customers. So there is a relationship which they have. They have broadcast license, which government has given to them. Again, that is an intangible asset. They have created a specific content for those on-demand channels, finance, history, education, so on. So there is a lot of content which they have developed. And then there is a goodwill, because if you see they have acquired for 0.8, but the fair value is different. So obviously there is a goodwill element also involved. And then comes that how would you, as a valuer, value these intangible assets? So there are different methods. We will look at each one of them. But broadly, there will be relief from royalty, excess earnings, cost, greenfield, with or without. And then as a valuer, what we will do is we look at all these intangible assets, then we will assign which approach I will be using, basis, and what is the rationale, right? In all the cases, if you see on the right-hand side, there is a rationale that there is no observable market data available for any of the intangible assets, which is very clear that eventually you will not be able to use the market approach over here, but either you can use the income approach or the cost approach, right? And depending on different asset, in some cases, for example, technology, you would see there are two approaches which is being used: excess earnings and with and without. So that is also very important, that you can both are income approaches, but you can look at how the value of the asset changes. You can give a range of values basis these two approaches. So every method approach needs to be justified, and that we will see in a practical example. So before we get into a specific approaches, any questions? Anybody has any clarifications on this specific case study?
Sir, could you please shift the slide back to the
Sure.
valuation slide?
This one?
No, sir. One more back. So, sir, in this slide, the discount rate is taken at 12%,
That's correct.
and internal rate of return 12% reflect a market-based WACC and after-tax composition of 5 to 6%, and cost of equity 15 to 16%.
Correct.
So, sir, my question is, by calculating WACC, while calculating WACC, we consider beta of various competitive firms, various competitive organizations available on the market or by other data. So by beta, we will have a systematic risk coverage. What about the unsystematic risk coverage of the client or of the entity? So whether we should ignore the unsystematic risk while valuing on income approach, or in case we want to measure the unsystematic risk, how could we do that?
Okay. Okay. So my first question to you would be that do you know what exactly is unsystematic risk?
Sir, under unsystematic risk, it will be company specific risk, because while we calculate beta has an assumption of a perfectly diversified portfolio.
Correct. So unsystematic risk is your company specific risk. That risk you are measuring basis beta. Correct? When you are measuring that risk, which is you're taking into account that whatever would be the market fluctuations, it'll get covered. But as far as the systematic risk is concerned, that only will be managed, or let's say mitigated, using diversification. So in such situations, measuring systematic risk. Now, for example, there is a Russia-Ukraine war, correct? Now,
Yes.
obviously, everybody knows that the inflation is across the world. You take it US, UK, Europe, in fact, India also. All of them have topped the charts now, right? Because there is a lot of the petrol prices, the fuel prices are increasing, which is impacting. Now, this is something which controllable or non-controllable?
Non-controllable.
So non-controllable, if you have a portfolio of assets, now you would have read in the newspapers that now people are shifting from equity to bond or to gold to some extent, right? Why? Because that is a diversification. So in case of a company specific, now if they have these, their businesses only radio, right? Satellite radio. But now what they have done is they have added this on-demand content. Maybe they will have to innovate some other product also to actually manage the systematic risk part of it. But otherwise, whatever is uncontrollable part, you will not be able to manage that. I hope I was able to answer your question.
Sir, one more question I have.
Sure.
Suppose we are taking beta from the data of listed companies. In
Yeah.
case I am I am valuing an unlisted company.
Hmm.
So what I used to do, I charge a unlisted premium to the discount rate. What are your
Understood.
opinion on that?
Okay. Okay. So the first thing is we are slightly digressing from intangible asset, which is fine, but this is important also. So your question is that the beta which you have taken, you have considered the beta of a public company to, and you're using this beta as a range or maybe as a parameter to value a private limit company. Is my understanding correct about
Yes,
this?
yes, sir.
Okay. And you are doing some kind of a subjectivity where you are adjusting this beta, right? To
Yes,
act. Okay. So how are you adjusting this beta? On what basis?
sir. I am calculating in few reports. I have seen that they are adding a premium of 10% of the cost as a unlisted risk premium.
Correct. Okay.
So I am doing all that, sir. Suppose
Okay.
in case as an example, my cost is coming by way of beta is 13%. So I am adding 1.3% as a unlisted premium.
Okay. Okay.
Yes.
So I will tell you what exactly I do, right?
Okay, sir.
Now, what I do is first, if I have to calculate the weighted average cost of capital, right? So the beta, first I will look at the industry beta, right? And basis the industry beta, I would know that what is my overall equity risk premium. So either would I have a risk premium for that particular industry, and basis that beta, I'll arrive at the specific discount rate or maybe the cost of capital. Once that is, of course, this is for India and industry in India. And this information is available in Mr. Ashwath Damodaran's website. So he provides specific information by industry.
Yes, sir.
Then what I would do is I will add a company specific risk premium. So the approach which you are taking and I am taking is almost on the same lines, but maybe you are adding 10% on the beta. But what I'm doing is because now I'm looking at the industry, that industry is based on whatever is the public data available. But now I'm valuing a private limited company. So what I will do is I'll add a specific equity risk premium. Now, how will I add that? So for example, if my overall cost of equity comes around 13%, 14%. So based on the scale, based on certain judgment, based on what is the future of the company, based on the geography it is covering, right? And whatever comparable I have, I will add a percentage that could be 2%, 3%, 4%, 5%.
So
The
my question is how to calculate that percentage.
that would be a subjective case, absolutely subjective, case to case basis. So recently I did a valuation where I calculated 3.5%. So 3.5%, the reason being because eventually my overall cost of equity was coming around 15%, right? So because the company, the numbers which they gave me from a projection perspective, they were not very promising. I could see there is a deterioration also happening in the net profit. So I added more to the risk. So normally I took 20% of 15%, which is 3. And as a subjective, to be more conservative, I made it 3.5%. So 15% plus 3.5%, I took 18% as my discounting factor. Does that
Okay, sir.
help?
Yes, sir. Thank you, sir.
No problem. Anybody, any other question? Okay. So this was the case study. And now what we will do is we look at each and every approach and the method, and then we'll come back to the case studies. So you might see me switching between the slides, but please bear with me on that. So that will give you a perspective about how do we do the calculation basis these approach. I think this part we discussed. Now, first is the market approach, right? Now, market approach, as we all know, that we use it basis the market data, but very important that we should have identical or similar assets, right? If you have to use the market approach, but that becomes the biggest challenge. And there's a lot of subjectivity which comes into place. So publicly available data, though it might be through a portal, money control, or maybe any other online website, but again, that is always challengeable. And recently I was doing a valuation for one of the, in fact, I'm still doing it with one of my friend. So this is more about a company which is into placements. Now we have to see if there is a comparable public limited company which is there. So when we looked at, we saw that the public limit companies are, apart from the placement services, recruitment, they are offering a lot more than that. And there's a lot of information available publicly, but it is absolutely not apple to apple. So it is not possible to do any kind of a comparison or a market approach using that. So there will be a lot of subjectivity involved. So eventually we skipped that part. We looked at the income approach. So that is where the challenge comes with market approach. And then there are two methods: valuation multiples, capitalization rate. Same thing what we have that in terms of EBITDA upon sales, or maybe EBITDA per user, depending on the asset which we are valuing. Or there could be a guideline pricing methods, which would be if you have a similar asset and you can use that similar asset using certain value multiples and then arrive at the value. But again, this continues to be a challenge. There are different sources of information, company filings, court rulings, or maybe any portal website. In fact, a lot of paid services are also available right now. And some of the intangible assets which can be measured using market approach will be technology, trade names, domain names. So this is where you can use the market approach. And very important, before you consider using the market approach, so always have a check that these two criterias should be satisfied. So the first one would be that there is an arm's length assumption. Wherever there is a transaction, if you are looking at a guideline pricing method, which is usually used, so there is an arm's length transaction, and the information is available on identical or similar intangible assets, or near or on the valuation date. So arm's length assumption, identical similar intangible assets on or valuation date. Very, very important. And there is a sufficient information which is available that the valuer can adjust. So the example which I gave for ESOPs, so if you see that we didn't have sufficient information available to us where we can do the adjustment using the public data or the observable data which we had. So if these conditions are satisfied, then you have all the arms and ammunitions to actually use the market approach. When to use market approach? So some of the common intangible assets like broadcast spectrum, internal domain names. But again, if you have the conditions satisfied, then only you can use a market approach. But broadly, these are the products which we normally use. Taxi medallions, basically there, if you have a taxi operating permit, or guideline transaction method is something which is more generally used whenever you use the market approach. So before we go to income approach, any questions on market approach? Has anybody done any valuation of an intangible asset from this group? Anybody?
Yeah, I got it.
So would you like to share? I mean, which approach do you used, or anything which is relevant to these slides, if you want to add something to it?
So there were two approaches. Basically, one is relief from royalty method, and the other one is with and without method. Wherein the relief from royalty, what we did was that it was kind of so it was in a way that if that particular name was given to a person from which a particular set of amount will be taken. And then it will be the share from the profits of that particular business. So that will be the future cash flows. Two types of cash flows. One will be the upfront payment, and the second one will be the cash flows that will be coming up every year. And we did a little tax amortization benefit on that, and that
Correct.
is how we, sorry.
Correct. No, I'm just saying, yeah, good. Okay.
We did a tab on that, and after that we gave the valuation of from the release from royalty method. From with and without method, it was basically on the customer's contract, wherein the company had two types of customers. One was the contractual customer, and one was the regular customer, but not non-contractual.
Okay.
We had to find out the so they were selling the company throughout, but they wanted to understand the valuation of the contractual customers. So we did a bit of with and without method on that, wherein we found out the annual billing to the company to those customers, and how what is the increase on that in the past years, and that is how we extrapolate on the future years, and then we did for the whole company, and we did it only for those customers, and did it for exactly for the non-customers, for the customers wherein the contracts were not there, and we by finding out the difference, we got that what is the value for the contractual person. These are the two main valuations that we have done, and then there are goodwill valuations on mergers that comes up from time to time. That is there. So goodwill, I think, is basically mainly on the purchase consideration method. So that is
Correct. Yes.
That is not necessary, but these are the major two things that I've done for this RB.
Interesting. Very interesting. So maybe once we come to those approaches, I might request you to add more flavor to that, because I would be very much interested to know that how exactly you arrived at the royalty rate. Because whenever we look at the RFR, that is one challenging aspect. And as far as this non-contractual customer is concerned, you use the with and without method, right? So
Right.
interesting that you were able to get the projections for that particular specific asset for with and without method, like with the customer and without the customer. So that is
Yes,
yeah.
that was kind of a tough job, but yeah.
Exactly. Interesting. So maybe I think once we come to those specific, I would request you can just add more flavor to it.
So I'll do that.
Thank you so much. Thank you. Sorry, I didn't get a good name. I'm not able to see over here.
Angad Singh.
Sorry?
Angad. Angad.
Okay. Angad. Okay. Thank you. Okay. So now income approach, right? Now income approach, I think everybody would know that this is always the present value of your cash flows, but it could be a cost savings also, right? And now it's very important that when we are valuing these assets, we should be able to attribute these cash flows, cash savings, specific to that specific asset which we are valuing. So that is a very, very important part. And income approach should be used only if these two conditions are met. So one would be your economic benefit associated with the subject intangible asset, and it has ability to generate income or reduce cost. So whatever could be the asset, either it should be able to generate income or it should be able to save cost, right? Because saving cost is eventually you're increasing the bottom line. So that economic benefit is very, very important. That is one. And second, these economic benefits are reasonably forecastable. So that is important. And usually for products like technology, non-compete agreements, trade names, trademarks, domain names, this is where we use the income approach. Now, within income approach, there are important concepts we have, like I think Angaji also said, the tax amortization benefit, and so on. So I'll cover these topics first, and then we look at a practical example. So in this case, if you see here, discount rate, very, very important, because discount rate will always depend on the risk and liquidity. And sometime back, we were discussing about the WACC, the beta part. So the risk element is very, very important. And this risk element will be based on two criteria. One would be the risk, and second would be the liquidity. So for example, if there is a specific asset which is already registered, right? So they definitely would be more riskier, right? Or if the patents in the process of research and development are riskier, they are in the process. They are not actually patented right now. Or if they are less liquid as compared to the trade names, trademarks, which are already patented. So whenever looking at the discount rate, this aspect is very important, which we should look into it and address this issue by assigning a reasonable premiums or discounts. So very similar to what we discussed for beta, where we're talking about the company specific risk premium, along with adding the equity risk premium for that particular industry. So this has to be very well reasonable, justified if you can add a premium or accordingly look at the discount rate. In many cases, what I've seen is that in case of intangible assets, since you have to derive the attributable cash flows for this asset. So there is a combination of IRR, which is your required rate of return, and your cost of capital. It is a combination of these two things which are taken to actually arrive at the discount rate. So that is what we do. And then this is a pictorial presentation. Basically, higher the risk, higher the discount rate. Obviously, higher the risk would be higher the reward. So you can see that the intangible assets and goodwill eventually will have a higher discount rate compared to your fixed assets and working capital, right? As far as goodwill is concerned, obviously the risk could be higher because that is where the business reputation is in place. It could actually improve the revenue of the business, or it could hamper also. So the risk increases. That is why in many cases you would see that the cost of equity or maybe more than working weighted average cost of capital is considered when you look at the discounting rate for these intangible assets which are riskier. Economic life, again, there is no specific thumb rule, but this depends a lot on your discussion with the management. How do you arrive at the specific economic life? Angaji, do you want to add something? I mean, when you were doing the evaluation for these customers, did you consider an infinite life or you looked at the finite life?
The time of the contract.
Contractual, but for non-contractual?
Non-contractual, well, basically, the issue was right there only because what we did was we calculated a proportion of the contractual and non-contractual, and let's say it was 40 and 60. 40 was C, and 60 was non-NC. Then we kind of kept the same ratio throughout on the increase of the revenues and till the time for 4 years. And after 4 years, we calculated that all the income, the growth rate was a little less, like I think it was 0.25 something percent. And we kept that the entity will have in the 5th year same revenues as the 4th year, but now the ratio of contractual will go up to 10%, and after that there will be no contractual.
Okay. So if I understood you correctly, then means 4 years was the life which was expected, and then
Yeah, 4 years for, and there was only one contract that was for 5 years. Then we kept only 10%, but for 4 years we kept 40.
Okay, okay.
That is how we derived the revenues. Not we, the company, we helped the company derive the revenues like that. Because even that was not a clarity. In getting such without the clarity and getting such things only where the best judgment and through the company's management and how the business is done. And they actually goes from different business to business.
Correct. Absolutely. I think in case of e-commerce business, it's always looked upon in terms of the returning customer, how often the customer is coming back, and what is since what time period. So then basis a certain weighted average method, we arrive at what is the example as a customer list. So what is the life of that particular intangible asset? But this all depends on a lot of factors. So there's a lot of analysis we have to do. We have to look at market conditions. We'll have to also look at also to have a very detailed discussion with the management about it. So this is a very important asset because eventually this life of the asset will help you to look at the overall value of it. In some cases, it might be infinite value also. Then you have to calculate the terminal value. But this is an important aspect when you're looking at the valuation of intangible asset. The next one is TAP, which is your tax amortization benefit. So very important part again, that whenever using an income approach, the TAP is always actually considered. But if you're looking at market or maybe your cost approach, then we don't look at TAP. Now, what exactly is a TAP? So there is a very simple example which has been provided in the table below. So I'll just read it out so that you understand the concept, and then we look at the practical part of it also. So there is a asset which has a value of 100 rupees, and the life of the asset is 8 years. So obviously the amortization per year would be your 12.5, which is 100 divided by 8. Then the tax rate of that particular company is 40%. And the adjusted weighted average cost of capital is around 17.34%. So if you see that here you get a benefit of 5 rupees. Now, how did you arrive at that 5 rupees? It is 12.5 multiplied by 40%, because the moment you show this 12.5 as amortization in your balance sheet, so you eventually end up saving tax by 5 rupees, right? Now, what we do is we calculate the present value of this 5 rupees for 8 years, because the life of the asset is 8 years. And we use the discounting rate over here, which is the weighted average cost of capital. And on the second column, you would see that there is a present value and there is 8 years where this 5 rupees every year has been converted into present value, and the total comes to 22.55. And the assumption on the third column, which is midpoint, so you know which is end of the year assumption or the midpoint. So here in an example, we have looked at the midpoint assumption. Basis that the total amortization benefit or the present value of that benefit is 22.5, right? So if the asset value is 100 and you're going to get a benefit of 22.55, so the balance what remains is actually pre-amortization benefit is 77.45. So if you divide 22.55 with 77.45 is the 29% of amortization, tax amortization premium. And then obviously it is 1.29. So whenever we do the valuation towards the end, I'll show an example that we apply this tab over here and then arrive at the value. So this is a very important concept whenever using the income approach. Anybody who has any questions or any clarification on this? Is it clear? Okay. Now,
can you explain this again?
Sure. So here, if you look at the table below, the asset is of as of now it's for 100 rupees, right? The tax life of the asset is 8 years. Basically, the life of the asset is 8 years. And obviously, when you divide 100 by 8, which means you need to amortize the asset on an annual basis. So like the fixed asset gets depreciated, intangible assets gets amortized. So you will amortize by 12.5 rupees on a yearly basis. Now there is a tax rate of 40%. So you will end up saving 5 rupees because 12.5 will be your amortization expenses in your P&L, right? And because the tax rate 40, so you will pay 5 rupees less as a tax because you saved because of this amortization. So despite there being any cash outflow, you are saving over here 5 rupees. Now, to calculate the tab, what we do is, since this is an income approach, we look at the cash flows, we look at all the future benefits and then calculate the present value. So here, this tab, to calculate tab also, we do the present value calculation for these amortization benefits. So 5 rupees every year is my benefit. But if I have to look at future 8 years, I have to calculate the present value. So based on my WSEC, which is 17.34%, my total present value of all the 8 years comes to 22.55. Is it clear so far, Charuji?
Yes, sir. Now, sir, ये WSEC यहाँ पर overall किसका लिया गया है?
वो एक assumption है यहाँ पे, ये तो आपको example समझाने के लिए, but eventually cost of capital जो है वो consider किया जाता है ना, discounting जो हमने पहले भी discuss किया, तो यहाँ पे इस example के हमने 17.34 लिया है.
Will it be specific to the asset or specific to the, or this is the WACC of the company?
This is the WACC of the company.
Okay.
Oh, sorry, this is the WACC of the asset. My bad. This is the
Okay.
WACC.
Okay.
Yeah.
Okay.
Yeah. So basis that 22.55 divided by 77.45, and then you arrive at 29%, which is a 1.29 is the factor. So this is very important. When you're using income approach, you'll have to calculate the tab also. Now, some of the common methods which we discussed, which are now we're going to discuss is multi-period excess earnings method, RFR method, without, and distributor or greenfield method. So this is one of the most prevalent method, which is called multi-period excess earning. And as the name suggests, that if that specific intangible asset is increasing the revenues, there is an excess of the revenues, that is where this particular method will come in place. And one of the most important condition is that if you want to use MPEEM, the asset should be a primary income generating asset. So in short form, they call it as a PIGA. If you satisfy this condition, then definitely you can use the MPE methods. If I read the second bullet point, just to give you more clarity about this method. So present value of excess cash flows attributable to the intangible assets to be valued as adjusted by the associated expenses required for the generation of cash flows. So a specific intangible assets, you can assign cash flows or attribute the cash flows to asset. Also, the expenses associated to generate that revenue. And then we have to look at the contributory assets also. So contributory asset basically means that, for example, Twitter as a company, they have this Twitter app, and that is like a product which they have, and that is everybody uses. So depending on the customers, and they have a lot of advertising revenue which they generate. But it's an intangible asset, right? So eventually what happens is, but Twitter also needs an office space, right? They would have a lot of money invested in the hardware, in people, uh, also on the servers. So different tangible assets. Now, these assets also eventually contribute to the revenue. So these are called contributory assets, right? So it is very important that whenever using MPM method, these contributory assets are also taken into account. I'll show with an example, and we exclude them when we look at the specific value of the intangible asset which we are valuing. So in case of Twitter, if they have to value that particular app which they have, they will have to first see that what is the expected revenue they are expecting from these other assets, working capital, tangible assets like fixed assets, PPE, and then basis that, segregating that, they will arrive at the excess revenue by using the app, and then that will help them to understand the value of this specific app, which is an intangible asset. So very important condition here that it should be a primary income generating asset if you want to use MPM. Now, if there are two different assets you have, if, for example, if you see the last bullet point, there is a customer contracts and intellectual property. So eventually customer contracts, let's assume in this example, is going to be a primarily income generating asset. So that would be used basis the MPEEM method, whereas your intellectual property could be used basis the other method. Contributory asset charge. So as I said in the previous slide, that your working capital, your fixed assets, these are contributory assets. Now, because let's say Twitter as an example, they would have a lot of other, Twitter has a logo, right? Twitter has an app, okay? But now let's say if you're looking at only one intangible asset, for example, the app. So now the logo, it becomes a contributory asset. So we'll have to segregate all these assets, and we'll have to look at that, what is the contribution of these assets to the revenue, which has to be segregated to arrive at the value of that specific app. Very broadly, what will happen is that you will look at these working capital and fixed assets in terms of calculating these contributory asset charge. So now we look at one example here. This is the same thing which I mentioned here, but one important part over here is that there is a concept of return on and return off. So if it is a fixed asset, you have deployed that asset. So the depreciation of that asset is eventually, in a way, you're getting a return because you're going to save money. It's an expense. And return on would be that what is, when you deploy that asset, what is the money you will be getting that. So in case of fixed assets, you would see that there is a aspect of return on and return off. Another example could be your bonds. When you invest in a bond, every year you get a money back, right? That is a return on your bond. But after the bond is matured, you get your bond money back. So that is return of the asset. So this aspect is also considered when we look at the contributory asset charge. These are the broad steps, right? So first you will assess the operations and determine what is the primary income generating assets. estimate future revenues, then estimate expenses which are helping to generate the revenue, then adjust the expenses for if there is any kind of a haircut for that specific asset, because you might have cost of sales, sales and general and administration expenses for all the products. So you'll have to segregate that. Then you have to determine the type of asset, right? If it is a customer asset, it is a trade name, and then you'll have to arrive at the approach also, right? Then estimate the rate of return on that particular asset for contributory asset, your working capital fixed assets. And then you have to compute the CAC, which is a contributory asset charge. And then after once you subtract that total earnings from these charge, you will arrive at the excess earnings there for that particular asset. And then to calculating the present value, applying the tab will give you the fair value of that particular intangible asset. So this is an example. Now here what they have done is they have same thing which we discussed, the case study. This is for customer as a intangible asset, and the method is excess earnings method, which is the income approach. Now here if you see on the left hand side, these are the projections, right? So you would see they have taken the revenue 945, 992. This is the forecasted revenue. Since this is the customer, now they have looked at the customer erosion, which means they are expecting that there would be a certain erosion in the number of customers. The first revenue is total revenue, and then since there is an erosion, so eventually the customer revenue also will start declining, which you can see in the third row, which is 756 going to 316. Then there are different expenses like your cost of goods sales, operations, selling and marketing, general administration. These all expense are specifically attributed for that particular customer as an intangible asset. Then they have arrived at the EBIT. Then there is a tax of 35%. And then you would see that the point number 4, which is a contributory asset charge. So I'll just go to the next slide to show you. Now, if you see here, I'll just take an example. Like if you see fixed assets, 3.3%, right? Now, what is happening is 3.3% of the revenue is your 25, right? So that is your asset charge, which is actually being created from fixed assets. Similarly, brand, working capital, license, workforce. I'll show on the other side how they have arrived at this as an example. But if you see what they're doing is they're excluding all this part from your total income or cash flows you have generated, and then arriving at the final cash flows. Then the discounting, which is 15%, they have considered over here as an assumption, arrived at the present value, and total comes to around 144 with the residual of 31, and then applied the tab. So tab here has been assumed, and the amount is 203. So basically, customer as an intangible asset here would be valued at around $203 million, right? And to understand the contributory asset charge, let's take an example of PP&E, your fixed assets. So you would see the opening balance is around 438, which goes to 446. Then there is an increase in capex on a yearly basis by 100, right? Then there is a depreciation of 20% based on the value of the asset, and the finally ending value for each year has been put in the fourth row, which is 440, 442, and so on. The expected return on this asset, fixed asset, is 8%. Now, how did they arrive at 8%? So that is based on the assumption, right? So basically, if they deploy the same amount, or maybe they source this amount from, they do a funding, or if there is any kind of a lease, any kind of a secured lending which they have to do for the same amount, what would be the amount which they need to pay, right? Like a cost of funding. Ishwara ji, can I request you to please put you on mute? Yeah, thank you. So here you would see that what they have done is the return is 8%, and then the revenues, this is the total revenue which they have taken. So the expected return on these assets is 8%. For example, if like a 2011, 35 as a division of 945 of revenue, 3.7%. And so on, they have calculated for all the years. And the average, what we get is 3.3%. So which means this 3.3% is basically your capital asset charge. And if I go back to the previous slide, you would see fixed asset is 3.3%. When I multiply the revenue with 3.3%, which is your existing customer revenue, I'll get a capital asset charge of 25 rupees. So this is a contribution of that fixed assets. So I have to exclude this from my total EBIT, and then I have to calculate my total cash flow, which will be eventually discounted, and then the present value. So this is how the contributory asset charge is being calculated. Is it clear? Anybody has any questions on this?
Excuse me, sir.
Yeah.
Sir, in the last in this slide, you are mentioning tab as 28. So how does this tab has arrived? Means what multiplication or what factor has been arrived?
So honestly, there is no specific calculation. I put it over here. But if you look at this example,
yes, that is 1.29.
Yeah.
So how did we arrive? Means where to multiply this 1.29?
So what they have done is eventually in this case, there is a tab of 28 on the total, right? So
Okay, how does this come? Yeah.
So it's around 14%. So based on the asset value and all that information, so I'll just say, like, for example, 175 into 1.14 will give me 199. So around 15%. So basically the tax amortization benefit, if you see the tax rate, what they have considered is 35%. There would be a asset life of this customer that could be maybe 8 years or maybe more than that. Basis that they would have calculated, same approach, exactly same.
Okay, that calculation I understood, but that tab factor I couldn't get. Means how does this tab factor has arrived, and to which we have to multiply this tab
Okay,
factor?
understood. So let me first give you this example. So if you see here, 29% is clear and 1.29 is clear. Correct?
How does this 1.29 come?
29 divided by 100, because that is the additional premium you are getting, right?
Okay, right.
So that is 1.29. So what you will do is here, in this case, if you see the total value is 175 before tab factor. Right. Now, in this case, the tab factor, which I know as per the calculation is 15%, which is 1.15. So I'll simply multiply 175 into 1.15. You will see around 203.
Okay, got it.
Got it?
Means that is including 1.15 is including tab.
Yeah, that is the tab factor. You have to use the tab factor. Correct.
Okay.
Correct.
Yes, sir. Thank you.
I'm glad you asked. Good question.
Thank you very much.
No problem. Anybody else? So we have only 25 minutes, so I might be a little fast, but do let me know if there are any questions, because some of the some of the examples will be very easy, so we can go a little faster in that. But income approach is very important because that is very, very prevalent. This also we discussed. Then say if you see here technology, because same thing, customers was one of the intangible assets which we did that was based on the total revenue. Now what they have done is they have calculated the value of technology. If you remember, ABC had done the R&D for 5 years. They built a technology for on-demand content, right? They created those specific 6 channels for on-demand content. So exactly same approach over here. They have calculated the technology, the value of technology intangible asset. So revenues, if you see here, now in this case, revenue has been considered only for the on-demand forecasted revenue. Why? Because the technology was developed only for the on-demand business. Those specific 6 channels. There was a content created for that. So that is why this technology cost will be based on only for that specific revenue. So the revenues for that is 71.99 and so on. Then all the expenses are specifically attributable to this specific asset. So then they have arrived at this. Now, if you look at the 6th point, which is your contributory asset charge, you would see content 27.3%. Why I'm talking about this is because content was developed only for on demand. And if you go back to this one, you would see 27.3%, which has been calculated over here for content, exactly in the same fashion. So that is where this 27.3% is used. It has been excluded. Why? Because content maybe as a intangible asset is separate, but right now we are looking at a very specific intangible asset is a technology, the process, the way they will deliver that content, that technology. So if they have to sell it, so they will sell only the technology, the process. So you would see that for two different assets, one is the technology and second is customer list. They have calculated based on the MPEEM method. Now let's look at the RFR method, a relatively simple method compared to MPM because you don't have any contributory asset charge. Now the premise on which this method works is that there is an assumption that if you have a license, right, or if you have a trademark or you want to give that trademark for somebody to use, so eventually what happened is that you charge a particular amount to them, right? Now because you own the trademark, you own the license. Now let's say if you don't own it, you might have to pay a royalty to use it. Maybe you will have to take this specific trademark or a license on royalty basis. So because you are owner of that particular trademark as this intangible asset, you are saving on the royalty expenses. So basis this premise, the owner of this particular asset is relieved from paying the royalty. And that is why this is called relief from a royalty, right? So this is one of the income approach, and some of the key assumptions here are the future revenue, which is obviously part of your overall. So uh, if you are paying the royalty, which means what is the revenue of your specific business by paying the royalty, and then what are the expenses, royalty rate, and then the discount rate. So I'll cover that with an example over here. Yeah, some of the important things which you should consider for royalty rates is if the asset, now there are 4 different criterias, right? If you want to look at the royalty rate is something which will be very critical, and I might request Angad sir also to share some perspective. So here, if you see 4 different aspects, one is the asset. So if you remember the example which I had given, if an asset is bundled, if a pharmaceutical company or the principal is giving the license to actually manufacture the drug, but along with the patent, they are also giving the formula to manufacture. So there are 2 different assets over here. It's a combination of 2 assets. It's not in isolation. So you have to always take that into account if you have to do the valuation. Then the rights. It could be a rights for a geography. It could be maybe for a specific area or maybe for a specific asset. So for example, when ZTV was acquired by Sony TV, right? Now ZTV has all the regional challenges, challenge. So if you go to South India, East India, North India, they have regional language based channels. Sony TV never had it. But ZTV gave the rights to Sony TV to actually all use this channel. But along with that, there will be a lot of other intangible assets. The content of those channels also would be part of the CTV. So it's very important to understand when the transaction is happening between Z and Sony, what is the rights which they have given? Is it only for the content? It is only for the regional license to operate in the specific regional space, the geography. That is important. Economic returns, I think it is very well understood. Upfront fees, of course, it depends. Sometimes when you are actually using an asset, so they might the person who is actually giving to use asset, they might expect some share in the revenue. If you're using Amazon logo for your own e-commerce portal, Amazon might have 2 different ways of dealing with you. So if they want to give your logo, give their logo to be used, either they will ask you an upfront fees for 5 years, or they might say that whatever revenue you generate because of using the Amazon logo, then you have to pay based on that. So this is also very important aspect when you look at considering the royalty rate. So these are the broad steps, I think very straightforward. In this case, the key would be the royalty rate. And once you have the projections, apply the royalty rate. We'll cover this with an example. That will be easier. So same case study, ABC Limited. Over here, if you see, the revenues are total revenue, right? This is your on-demand revenue plus your current customers' revenue. Then there is a royalty rate which has been assumed to 3.5%. So here, if you see the second box, which is royalty rate, there is a research which is being done based on two scenarios. One is B2B and second is retail. So if it is a B2B business, the margin is 89%. If it is a retail business, the margin is 92%. So that difference is around 3%. That has been used, or there's a research being done basis that they have arrived at the value of 3%, right? Around 3%. So then that they have used as a royalty rate. So you would see revenue multiplied by royalty rate, that would be your actually savings, right? Then you apply the taxes. Then after tax, what is the total royalty savings? Now, because they have assumed an indefinite life for this, so there is a terminal value which they have calculated based on the growth of 2.5%. Same formula what we use for the terminal valuation. So applying the 2.5% and 16.5% as your cost of capital, they arrived at 216. Then the discounting period, discounting factor, present value, then they arrived at the 198 million is the value of trade names. Applied tab, same thing what we did in the previous slide, 227. So this is how they have used. Now you would see they have taken the percentage of royalty rate over here. So this is a difference in approach. And specifically, if you want to value trade names for which you give license, right? This is where you can use that method. Any questions, or Angad sir, if you want to add something to it for the benefit of all?
I think you've covered most of it. Basically, just one thing that the royalty rate varies from business to business, and if we talk about different royalty rates in the restaurant business, we have seen a royalty rate of 10% as well. So the major point is that even if you have the royalty rate, the major problem is getting the revenues done, because you can never identify the right revenues. You can obviously have in all the intangibles, the biggest problem is getting the revenues and the projections done right. So I think that is where the major effort lies. The rest of it is all formulas and your personal experience and expertise. But the projections are the major thing that does everything. And if the investor, if you're talking about the investor's perspective or the company's perspective, both of them may have different approach, because at one point I was doing a valuation where the investor was valuing the intangible at 1 crore and the customer was valuing the intangible at 30 crore.
Okay.
That is, once we get on the practical side of it, then it has a lot of issues, not just these how the valuation is done, but actually what is the base back, how we are getting the numbers as well.
Understood. So I'm sure you would have dedicated certain section in the valuation report about how did you consider the royalty rate, correct? Because that is a very important part.
Majorly through three things: market research,
correct,
and management review, because management always has the more idea about the project.
Yes, they will have a say in that. Absolutely right. Correct.
And third one is if we have been appointed by the investor, then making the investor spend a little extra money and getting reports from the market. So that is how we usually do it.
Great. Thank you so much, Anga sir. Very helpful. Anybody else, if they want to add something or they have any questions on this RFR method?
We are not on RFR.
Yeah.
But I was just, we had an opportunity to evaluate something where one of the intangible where the bank appointed us
Okay.
And thereafter, one of the consumer brand was supposed to be evaluated
Okay.
for the financing purposes. And once we worked out based on the standard methodology, what we also learned, and it was important for us, is how does the overall value of the brand under the RFR method or any other method corroborate with the overall market cap of that listed company. And we could figure out that the value of the brand itself was significantly higher than the market cap. And so we had to recheck and also corroborate how we do this in terms of the royalty rate and the discount rate. So important point for everybody is to cross-check the benchmark values with the overall value and the purpose for which. You don't want to get into a similar case like the other in the earlier case that you mentioned about financing of an intangible.
Correct. Correct. Thank you, sir. This was very helpful. So just one clarification, if I have understood correctly, it's a public limited company, if I'm not wrong, because you're looking at the market cap, right?
Yes.
So you're saying that the brand value which was calculated, it eventually came out to be more than the market cap. And then you
That's
have to,
correct.
okay, and then you have to readjust that, rejig the numbers basis the discount rate, and then arrive at the right value, right?
So we had to figure out whether the entire revenues of the companies pertain to the brand. In a simple case, we could have just taken the entire revenue first.
Yes.
Second, is it really a B2C or a B2B brand or a
B2B.
semi-brand?
Yes.
And third, what was the royalty rate? Should it be a 5%, 3%? Where does it fit into? Then we also saw the past history. The brand was a good turnover brand, but not making profits.
Okay.
So that also gives us an indication that the forecast could show a rosy picture.
Absolutely.
But does the past results support in terms of operating profits?
So overall net profits you were saying were very lower, and that is where, correct?
Virtually on break even to negative.
Oh, okay. Understood. So in that case, I think, yeah, income approach obviously would be for brand value, but okay, very interesting. Thanks a lot, Pinkesh sir, for sharing that. Very helpful.
Thank you.
Okay, so since we have only 10 minutes left, maybe I might rush a little. I'll cover some of the important points here. So with or without method is again a part of your income approach. But again, this is considering whether what if you have that, what is the revenue generated with the specific asset and without the specific asset. So difference between these two would be your asset value. So if I look at a very simple practical example, the steps are very straightforward, but in the steps, one important point is that whenever you are obtaining the projections, you would need the projections for both scenarios, with the asset, without the asset. So that is very important, because otherwise you'll not be able to arrive at the value. And then this approach is usually used for non-competing agreements. So if there is a competition agreement, obviously the revenue would change, and if it is not there, the revenue would change. So that would be the impact and eventually help you to calculate the value. So here, if you see technology, which was earlier used based on excess earnings method, this has been again used for basis the W or WM method, right? So I think the left-hand side is very straightforward. They have taken the total revenue, also looked at the on-demand revenue, then taken into account the cost, then your total after-tax earnings, impact of capital, working capital. Then based on the long-term growth, they have arrived at this the residual value also, which is point number 41438. And then they apply the discount, and the present value which comes for this particular technology is 1038. Using the same approach, if they do the calculation without technology, sorry, this is without technology. If they do with technology, obviously the revenue will go up, which is around 199. So the difference between these two is 1661. Apply the tab factor, and you would see that this is 188. So with or without method is giving me 188 million as a technology value. And if I go back to MPM method, it is giving me around 141. So this is where the value or judgment has to be applied on case-to-case basis, where you can provide a range of values for this specific particular asset rather than giving a very specific value. So this was with or without method. Then greenfield method, again, very similar to excess earnings. The only difference over here is that if you remember in the excess earnings method, we were looking at the contributory asset charge. So calculating that how much each asset is contributing to the revenue. But in greenfield, it is considered that these assets either will be built, bought, or rented separately. So you actually consider that if Twitter is actually building the app, if there is a new Twitter which is coming place, so app would be one part of it, but rather than considering that how much the fixed assets working capital is contributing to this specific revenue of the total business, they will look at actually assuming that these are need to be rebuilt. All the assets needs to be acquired, bought, or rent. So then you don't have to add to the revenue. You have to only look at what is the expense you will be incurring for getting these assets in place, contributory assets in place. And usually for this one, this is used for broadcast spectrum intangibles. This is a broad step, which I think is very straightforward. Now, if you see a greenfield method, again, the same example. Over here, they have looked at the total revenue because they've assumed this as a startup. And then basis that they have arrived at all the expenses, EBITDA, CapEx, and you would see that because being a startup, overall, the EBITDA is negative, right? Because there is a lot of investment which is happening in CapEx in the initial days. So cash flow is negative. But after the fifth year, 2014 onwards, this becomes a little normalized basis which they have calculated the residual value. And then finally, calculating the present value using your 20% discount factor. Because in this case, it being a startup, obviously the risk would be higher, right? So the rate of the discount rate also eventually would be higher. So if you remember that pictorial graph, higher the risk, higher the discount rate, and hence the overall value for this license would be around 43 million. Cost approach, very straightforward. I think this is not used very prevalently, but broadly there are two areas. One is either you reproduce the same asset, is that exactly giving the same utility, or you replace the asset, right, in the current prices with the same utility. So if I have to explain you with a very simple example, first we can just cover the criteria. So very important. If you have to use a cost approach, you have to ensure that these criteria are met. Like one is market participants. There's a so there is a possibility to recreate by market participants one, and it is the asset is going to give the exact similar utility. Second, there are no legal restrictions on type of or are there any barriers to recreate it. And third, that this can be recreated and the market participant will not be willing to pay a significant premium for the ability to use. So basically, participant specification is not there. It is basically open and they can recreate it very easily. There's no premium attached to it. If that is the case, then you can use the cost approach. Very simple example, ABC company was acquired by X. ABC company had actually a in-house built software which they were using, and this is not an income generating asset. It is not PIGA. So obviously this cannot be valued on a income basis now, and there is no potential economic benefits, but this is a process improvement which the software is helping them for their internal operations. Now, if X has acquired ABC, so there has to be a valuation of this specific software because eventually X would be using this software also. Now, this software has been there for 6 years. ABC has already used for 3 years, which means the 50% of the life is over of this particular asset. So they have calculated that what if they had to rebuild this asset with a reasonable efforts. So estimated number of hours will be 8,000. Cost per hour would be 40, which will be total value will be $3,20,000. Overhead is 30%, which is 96,000. Indicated value will be 4,16,000. So there is a typo. It's 41,600. So please ignore that. It's 4,16,000. Now, because this asset has been used for out of 6 years of life, it has been used for 3 years. So we will actually deduct 50% because it's obsolescence, and hence the value which they have to account for will be 2,08,000. So this is a very simple cost approach which can be used only in cases of assets which are not income generating. Using the ABC example, if you remember the content which they created, they developed the technology, they created content for 6 different types. They created these modules. So if you look at the center table on the left hand side, you would see 6 different programs which they create. There were 30 and 60 minutes modules on the radio which they were broadcasting, and the number of modules total was 1,000. Then they calculated the cost per minute was 1,000 per minute, $1,000. Eventually, for each and every content, if they had to recreate it, they will actually spending 1,000, and the replacement cost would be around 60.4 million of the total content. But because some of the contents was outdated, obviously in case of taxation, if the content was 2 years old, 3 years old, the tax rates would have changed. Or maybe in case of any health or parenting, if it is active. So they deducted all these specific contents and then arrived basis 1,000 or 1,500 or 2,000 per minute. What is the value of this content? So this was a depreciated replacement cost. Again, this was used a cost approach. So this is how you arrive at the intangible asset, which is your content, using the cost-based approach. Any questions? I think we are done. Yeah, not bad. So I'm sorry I couldn't give much time on the Q&A, but if there are any questions, we can definitely continue for some more time with permission of Sharma sir and Sarita ji.
Yes, sir. Yes, sir.
Thank you, Sharma sir. Anybody, any questions?
Sir, how to arrive the royalty rate in case of different kind of business means? Suppose I have calculated one copyright of a business, means of a book. So how to arrive at the royalty rate of that copyright?
So basically, you would be actually the copyright of the book has been given to the publisher.
Yes.
The publisher will publish the book, right?
Yes.
And based on, now again, there are different models to it. So based on that, the publisher will actually have an agreement between the writer and the publisher. There are different models to it. So either it will be lump sum payment or it will be based on the number of copies being sold. Correct?
Okay. Yes. Yes.
So number of copies being sold, there will be an amount which will be arrived.
Yes.
Right? So it depends on the subject of the book. Okay. What market it is catering. It is catering to youngsters. It is catering to parents only. It is a financial subject. So there will be different aspects which you'll have to look at it. And based on that, whatever market data is available, you'll have to put a judgment call and arrive at the royalty rate.
So from where we'll get the market data?
I think market data, I don't have a direct answer for that, but again, it will be depending on, we have to do some discussions with the management or with the publisher, that there is always a range of royalty rate. Once you have information about what is the content of the book, what is the market it is catering, probable readers, you should be able to get some idea, some range of rate. You might have to, that you can do it. Google also might help you in some.
Thank you very much.
No problem. Anybody, any other questions? Okay, so I'll take that silence as no. And thanks to everyone once again for being such a wonderful audience. Special thanks to Angad sir and others also who contributed to it. It was very insightful for me as well. Good learning experience. I hope I was able to do some justice to the subject, though couldn't cover everything in detail. So thanks once again. Over to you, Sharma sir.
Oh, yes, sir. So we have come to the end of this CEP. And this is the time to thank everyone associated with this program. First of all, I thank our speaker, Kukreja sir, for associating with us and taking this assignment and covering the subject which I treat as a very tricky one, very nicely, and all aspects were very nicely covered. Thank you very much, sir. And I thank our participants also. Thank you very much, everyone.
Thank you,
Please
Prakash ji.
share your feedback and
Yes.
Please
share
to share
and
feedback.
suggest a topic for our next CEP, and please remain in touch with us.
Excuse
And
me, sir.
thank you,
Sir, can we get the PPT?
Yeah,
yes,
sure.
yes,
I'll be sharing the PPT. Yes.
yes,
Okay.
yes. We will be sharing PPT with them.
Okay. Thank you.
Thank
very
you,
much.
Madam Sarita and
Thank you, sir.
Urvashi and Shweta. Thank you very much.
Thank you, sir.
Thank you.
Thank you,
Okay.
Prakash ji, again. It
Thank
was
you.
quite a detailed one.
Thank you. Thank you so much. Everybody have a good day. Good weekend. Bye.
Thank you.